All right, guys, welcome back to the channel. Today we are talking about GDX, the ETF, and how you can make income from an ETF like this. Now, the way we're going to go about this, first of all, is called the wheel strategy. If you're new to this strategy, I recommend you come on over to dailyinvestmentadvice.com. This is my website, and what I've created here is a website for investors like yourself to come over here and learn education. Learn about the markets. It's very easy to find your way around this website. You can go to retirement investing, stock trading, personal finance, options trading, and then of course the wheel strategy. So there's all kinds of topics on investing, personal finance, and I hope this will be of value to you as we go over the wheel strategy and other things on this channel. If you're new to this channel, we talk about cash flow and how to make portfolio income, not only from your stock market portfolios, but also from real estate, rental properties, REITs. You can do bond investing, stock investing, ETFs, the wheel strategy like we're talking about in this video. There's so many opportunities to make income, and that's the beauty of all of these different financial assets that are out there. Also, guys, check out our sponsor, Seeking Alpha. Seeking Alpha is fantastic for research on the stock market, tens of thousands of different securities out there. And if you want in-depth research on these different securities, including ETFs, mutual funds, individual stocks, all of the latest, best investment strategies out there, check out Seeking Alpha. It's a great website and a great way to get started, if you want to do in-depth research on the market. Vaneck Gold Miners ETF, GDX. I've talked about this one on this channel and my other channel. $39 right now. And gold and silver we know has been doing well. Gold has been hitting 2,600. I think it might have briefly touched 2,700 if I'm not mistaken. Silver has been on the uptrend as well. $31, $32 a share, an ounce. Let me see where silver is trading at. Silver price is $31.42, down 1.1%. Or 1.81%. But nonetheless, we have silver and gold that have been doing quite well. And so if we think about how we can earn income from gold and silver, as you can see in a consistent bull run since the end of 2023 primarily, we come on over here to Fidelity. Now, Fidelity is my favorite website broker for using options to make income. I actually have my portfolios and pretty much everything with Fidelity, and I really enjoy using their platform. Now, as you can see here, I have this trade set up to make $545.25. This is after commissions. Okay, so if you see here, our max gain is $555. Our max loss is over $57,000. Do not let that scare you. That would essentially be if this ETF went to zero. So if this ETF went bankrupt, the ETF shut down, it turned out to be a total fraud, and you lost all your money, that's what would happen. You'd lose the $57,000. But this is basically a diversified collection of gold mining stocks. And so what we're doing here is selling to open 15 contracts or 1,500 shares. Each options contract, whether you're selling a call or a put option, is going to be 100 shares. So 15 shares would equal 15 contracts, would equal 1,500 shares. So with that being said, 100 shares to each options contract, we're technically agreeing to buy 1,500 shares at a strike price of $38.50. Now, this option expires on October 11th. Today is October 7th. So today's Monday, October 7th, 8th, 9th, 10th, 11th. That would be Friday. So this option expires on Friday. For entering this trade, we're collecting over $500 after commissions just for being willing to buy this ETF at a strike price of $38.50 by the expiration of October 11th, 2024. Now, if we take a look at the chart here on the ETF, you can see that it's been kind of in an uptrend. And so if we assume that this option will expire worthless due to the fact that we can expect a higher uptrend, then we're basically going to collect the $500 in our pocket and do nothing else. And the reason for that is because if this finishes above $38.50, then we collect the $545 and we can do this again the next week. And as you can see, look how many options we have to choose from. Weekly options. So I've talked about in other videos like on SPY and also QQQ And also, I think GLD, SLV, there's pretty much daily options, or like at least once every 3 days, you can choose different expirations for options. On this ETF, though, it looks like weekly options is going to be the way to go about how you can do this wheel strategy. And the wheel strategy is pretty much just switching between puts and calls. And so, for example, if we sell 15 contracts with this put option, the expiration is October 11th. So let's say on October 10th, the ETF is down to $38 a share. And on expiration October 11th, it goes even lower, down to $37.50. Well, now we're on the hook to buy 1,500 shares at the agreed upon price of $38.50. And since the ETF is trading at $37.50, not $39 on expiration day, we are basically down $1 for all our shares, or about $1,500 on paper. But keep in mind, where else can you go and get paid to buy an ETF? And so the way you have to look at this, whether you're going to do this against GDX or GLD, SLV, is you have to be willing to buy the ETF or whatever it is, if it's QQQ, SPY, whatever the index is or the individual stock, you have to be willing to say, I'm going to buy this at this price and agree to it. And so it's kind of like buying any original stock or ETF. You take a risk on the price, and if the price goes down, so be it. The difference is this is just 1 week out, and we're agreeing to buy, and we're getting paid for it. And so we're basically getting paid to buy stocks and ETFs, which is a pretty cool concept in my opinion. Now for this trade, you would have to put up 1,500 shares at a strike price of $38.50, and the total premiums that you would have to, or I'm sorry, the total capital, 1,500 times $38.50, is going to be equivalent to $57,000. Now that might sound like a lot. You might be saying to yourself, well, we just can't do that. It's too much money. But think about it this way. If the maximum Roth IRA contribution is $7,000 and you do that for 5 years and you get, income, interest from your portfolio, you could probably work your way up to $57,000 if you don't have it in there already. And so if you want to do these types of trades and make these types of moves, yes, it's going to require money. Now, some trades are going to require less capital than others. But you could always diversify between different ETFs, different stocks. Remember, this is with 1,500 shares. You could also just start small and try this with one contract. So in that case, we're only going to make $36 on the same trade. But we're only buying 100 shares at $38.50, which is only $3,850. So it's much more reasonable, less than $5,000 versus $57,000. But if you theoretically wanted to make, let's say, $500 a week, maybe this could be something to consider. So for example, if we go out one more week, basically to October 18th, about 11 days out, now we're talking almost $900 for this trade. So now we're still talking about $450 every week from these options. And so this is what you can expect, kind of. You have to deal with volatility. You also have to deal with the fact that if you sell a cash secured put and you get long the stock, let's say at $38.50, you then have to turn around and try to sell a covered call. So now we can say, well, the price is $39. Let's go ahead and sell a $39.50 call option. We'll say we already own 1,500 shares. We'll sell at the bid price of 71 cents. But now we're actually collecting over $1,000. And so you can see this is very variable, but it can be a consistent source of income if you play your cards right. And that's what I love about this against ETFs like GDX, QQQ, SPY. And what I also tell people is to try to diversify as much as possible with the wheel strategy, because all you're doing is trying to keep your price in line. If this ETF is trading sideways, for example, that might actually be a good thing, because if it's trading sideways, right, between $36 to $40 per share, then you're going to be able to do this wheel strategy, and you're going to be able to make a lot more premiums because you can just benefit from the volatility, up, down, up, down, up, down, and you're not really having to worry about the price fluctuating a huge amount, right? So that's kind of the idea. So one other concept I wanted to cover in this video is delta. Now, delta measures the degree to which an option is basically exposed to shifts in the price of the underlying asset. So it could be a futures contract. Basically, we're looking at values from 1.0 to minus 1.0. The point is, you can look at a delta on these call or put options, right? Let's say it's just out of the money. The strike price of the option is above the price of the underlying asset if the option is a call, or below the price of the asset if the option is a put option. the option will always have a delta value that is somewhere between 1 and -1. So an at-the-money option generally has a delta of approximately 0.5 or -0.5. So you can kind of look at this concept of delta and think to yourself, as you're doing this, a lot of people will say, well, look for a delta of 0.20 or less, right? So if you have this delta of 0.20 or less, then the idea is maybe you're going to have an 80% chance, because 20% of the time, essentially, what that's saying is that you're going to have an in-the-money option. So if you're buying this or selling this call option at $39.50, there's a 20% chance, let's say, that it's going to go in the money, and an 80% chance that you're going to pocket the premium and the option will expire worthless. So there's this concept of delta you kind of can look at when you're doing these trades. I just wanted to bring that up because it can be a powerful component to how you decide if you're going to make the trade, because it kind of determines your probability of success, because it's really related to this concept of volatility, or implied volatility specifically, and how that relates to the underlying options. So as you're doing these trades, keep that in mind. Volatility can be your friend, it can also be your enemy. If you're trading sideways, that can be a great thing, to be honest, because you can just continue to rack up those premiums. And kind of right now we're stair-stepping in this uptrend, but we're also kind of trading sideways in the GDX. So that might actually be a good opportunity to throw in this wheel strategy, at $38.50 or $38 for that first expiration on October 11th, and then kind of switching it around all the way up to October 18th, going and rolling those options over. So with that being said, guys, let me know what you think in the comments down below. Once again, the strategy we discussed in this video is the wheel strategy. Essentially, all we're doing is we are buying at least 100 shares of stock or an ETF, and we are doing that by maybe selling a cash secured put to begin, getting paid to buy a stock or an ETF. And so in this case, we can look at different strike prices, and let's say $39 is the strike price we want, or $38.50, whatever it is, and we have $830 right there. So we can collect these premiums on a regular basis, and then we can switch from puts to calls once we actually get long the stock or the ETF. So you can get paid to buy and sell stocks or ETFs on a consistent basis, is the way that I look at it. So thank you so much for tuning in. Hope you enjoyed this video, and if you guys have any questions, leave them below. God bless you all, and hope you're having a great day. We will see you in the next one. Take care.